Around the world, people are struggling with inflation and the rising cost of living. In fact, just last week we even discussed how major companies have seen big slumps in their valuation. Weirdly though, there's one major outlier: oil companies. That's right, despite international issues and the climate crisis, US oil companies have been making record-breaking profits. So let's explain what's been happening and, crucially, what this means for the net zero agenda right now. If you like financial videos like this one, then be sure to subscribe and let us know which topics you'd like to see covered in the future. To make this easy, we're going to split this video into 3 parts. Firstly, we're going to take a look at how from 2015 to 2020, oil companies were not having a good time, and they didn't look like a good investment. Secondly, we're going to explore why oil companies' fortunes reversed completely in 2021, with all of them posting record profits. And finally, we're going to be looking at whether or not these fortunes can continue, and what this means for the green future. So let's start with a recent history of oil stocks. Thanks to a recent drop in oil prices in 2014, capital expenditure between 2008 and 2014 when oil prices were high, and wider investor concerns about climate change, oil stocks haven't fared particularly well in recent history. In 4 of the 6 years between 2015 and 2020, energy was the worst performing sector in the S&P 500, and oil companies' shareholder returns lagged behind the wider market. The 5 largest international energy companies, ExxonMobil, Chevron, Shell, Total, and BP, have all had a tough time. Even before the pandemic, every single one of them was down at least 10% from their 2014 high, and BP and Exxon were down 30%. Things got even worse over the pandemic though, when demand for oil and gas dried up almost instantaneously. In April 2020, Shell cut its dividend for the first time since the Second World War, and in May, Exxon reported its first loss, a massive $22.4 billion since its inception in 1999. Exxon wasn't alone either. Shell posted a loss of $21.7 billion, Total $7.2 billion, BP $5.7 billion, and Chevron $5.5 billion. With falling costs for solar, wind, and battery technology, as well as widespread concern about climate change, there was speculation that 2020 would mark the beginning of the end for oil companies. That all changed, however, at the end of 2021. As you probably already know, the post-pandemic spike for energy means that energy prices, and especially gas prices, have shot up to record highs. Brent crude, the most traded oil benchmark, is up 50% from its pre-pandemic price of $60 per barrel. The Henry Hub natural gas spot price, the most traded benchmark in North America, is up about 150% from its pre-pandemic price, and reached a 10-year high of about $12 in February. Now, at this point, you might be wondering why global energy supply didn't just increase to meet demand, and there are basically 3 reasons. The first and most important factor is the Organization of Petroleum Exporting Countries, or OPEC. For those of you who don't know, OPEC is a group of 13 oil-producing countries, mostly from the Middle East, which essentially acts as an international cartel. When oil demand increases, OPEC get together and agree not to massively increase output, i.e. artificially suppress supply, in order to ensure that prices stay high, thereby guaranteeing themselves hefty profits. OPEC are often joined in their cartel-like behavior by another 10 oil-producing countries, including Russia, Kazakhstan, and Mexico. This loose grouping of 23 states is known as OPEC+. And to give you a sense of how powerful this cartel can be, consider that OPEC+ covers 55% of global oil supplies and 90% of proven oil reserves. Anyway, OPEC+ have so far refused to release enough oil to calm energy prices, which has kept energy prices especially high. The second reason why supply hasn't increased is that doing so, even outside of OPEC, takes time, because, well, you need to drill more wells and build more infrastructure. It's estimated that significant rises in US production would take 3 to 6 months to even come up to speed. Thirdly, and finally, most of the cheap oil sources, shallow water and conventional onshore wells are already pumping at full capacity, which means the more oil you extract, the more expensive it becomes, because you've got to start looking at less conventional and more expensive sources, like deep water wells and oil sands. Anyway, you get the point. These things combined explain why supply hasn't caught up with demand, which means that oil and gas prices have stayed high. Unsurprisingly, this has been phenomenal news for oil companies' bottom line. While the rest of the market has slumped, oil super majors have been posting record profits and watching their stock prices hit new highs. Exxon posted profits of $23 billion in 2021, including nearly $9 billion in its fourth quarter. Shell posted profits of $19 billion, Chevron $15.6 billion, BP $12.8 billion, including more than $4 billion in its final quarter, BP's highest quarterly profit since Q1 2013. We don't have numbers for total yet because European companies usually publish their annual reports in March, but we can expect more of the same. Now, it's worth saying that these impressive numbers aren't entirely down to good luck. Oil companies have also made some wily financial decisions. For starters, they've been investing heavily in natural gas, which now makes up 50% of their energy mix. The idea here is that natural gas, which produces half as much CO2 per unit as energy from coal, is likely to play more of a role in the decarbonisation of the world economy, and thus be in demand for longer. Oil companies have also learned from their mistakes of 2014, and have been taking care to only invest in relatively cheap oil projects. Goldman Sachs estimates that most oil super majors have a break-even price of about $40 to $50 per barrel, which means that as long as oil prices stay above that number, as they currently are, these oil companies will stay in the green. This number is down significantly from 2014, when the oil super majors' break-even prices range from between $90 and $150 per barrel, thanks to some overly optimistic forecasts about future oil prices. So you get the point. Energy prices are high, and energy companies are loving it. This leads us on to the last part of the video. Will these energy prices last? Well, in the immediate future, the answer is probably yes. Most analysts expect the current spike in energy prices to last until at least 2023, largely because, as we explained earlier in the video, energy supply is struggling to catch up with demand. In the longer term, well, it's harder to say. A lot of this will depend on whether the world can successfully decarbonize its energy supply, and what exactly decarbonisation ends up looking like. And, well, this will largely depend on how the world reacts to the current crisis. If the big takeaway is that divesting away from fossil fuels leaves you vulnerable to this sort of price shock because you don't have enough supply to meet demand, then oil and gas will continue to play a big part in the global energy mix in the future. If, on the other hand, though, the big takeaway is that the world needs to take the green transition more seriously and invest more heavily into zero carbon energy generation to protect itself from fossil fuel price shocks like this one, then that would clearly be good for the green agenda, but it would be bad news for these oil super majors who have placed an expensive bet on natural gas. Let us know what you think will happen next in the comments below. Do you think that the current crisis and huge profits will mean a more or less green future? Let us know your thoughts in the comments below. Also, be sure to subscribe to the channel and hit the bell icon to be notified every time we release a new video. Special thanks to our Patreon backers who make videos like this one possible. And if you want to see your name at the end of videos, then you too can back us on Patreon. The link to that is in the description.